It went from a startup to a $32 billion empire in just 3 years. Its founder was hailed as the most generous billionaire in the world. Celebrities vouched for it. A Super Bowl ad told millions it was safe. But buried inside the exchange was a secret piece of code. And it let one man treat his customers' money as his own. In a single week, $8 billion vanished. This is the story of FTX. A quick note before we begin. In the early 2020s, cryptocurrency was minting overnight billionaires. Few rose faster than a young man named Sam Bankman-Fried. Almost everyone just called him SBF. He was a math graduate from MIT who had traded at a top Wall Street firm. He spoke about a philosophy called effective altruism. The idea, he said, was to make as much money as possible in order to give it away. In 2017, he founded a crypto trading firm called Alameda Research. Then, in 2019, he launched a crypto exchange called FTX. An exchange is simply where people buy, sell, and store their crypto. Think of it like a bank for digital money. And like a bank, it ran on one thing above all else: trust. Customers were told their deposits were always theirs. Safe, never lent out, never gambled with. That promise was the foundation of the entire company. And prosecutors say that, almost from the start, it was a lie. To understand the fraud, you have to understand two companies. FTX, the exchange that held the public's money, and Alameda, Sam's private trading firm, making huge, risky bets. On paper, the two were supposed to be kept completely separate. In reality, prosecutors say, the wall between them barely existed. In 2019, just months after FTX launched, Sam gave an order. He told his engineers to write a piece of secret code, a hidden exception, buried deep inside the system. It gave Alameda powers that no other customer on Earth had. Alameda was allowed to go billions of dollars into the negative. It had what amounted to a $65 billion line of credit. And it was exempt from the safety rule that protected everyone else. Any normal account that ran out of money was automatically shut down. Alameda's account never was. FTX's co-founder, Gary Wang, later testified about that very code. He said he had objected that customers never gave permission for this. But the hidden door stayed open. Customer money could now flow straight into Alameda's bets. While that door stayed hidden, FTX exploded in size. By January 2022, the company was valued at $32 billion. Sam's own fortune was estimated at around $26 billion. On paper, he was one of the richest people in the world. And he spent lavishly to make FTX impossible to ignore. A glittering Super Bowl ad, starring a famous comedian. A major NBA arena, renamed after the company. Sports legends and supermodels lent the brand their faces. The message was everywhere. FTX was the safe, trusted future of money. Sam became a powerful figure in Washington, too. He donated tens of millions of dollars to political campaigns. He even testified before Congress on how crypto should be regulated. The disheveled young genius who just wanted to give it all away. It was one of the most admired brands in all of finance. And it was built on a house of cards. In 2022, the crypto market turned sharply. Prices crashed, and major crypto firms began to collapse one after another. Alameda, Sam's trading firm, was bleeding money. Its enormous bets were going badly wrong. An ordinary firm would have simply failed right there. But Alameda had that secret door into FTX. So it reached through that door, into customer deposits. Investigators say at least $10 billion in customer money was funneled to Alameda. Money that people believed was sitting safely in their own accounts. Sam would later call lending it out a poor judgment call.
Prosecutors called it theft.
For a while, no one on the outside could see the whole,
Because much of FTX's own wealth was an illusion.
FTX had created its very own coin, called FTT. It could essentially print this token out of thin air.
And both companies counted huge piles of it as if it were real money. As long as nobody looked too closely, the empire looked solid.
Then, in November 2022, someone finally looked closely.
A news outlet published a leaked look at Alameda's books.
Much of what propped up the firm was FTX's own homemade token.
Its assets were largely, in effect, funny money.
Days later, the head of FTX's biggest rival reacted.
Binance announced it would dump all of its holdings of that token.
With a single message, confidence simply evaporated.
Customers rushed to pull their money out, all at the same time.
It was a classic bank run, at digital speed. Billions of dollars in withdrawals were demanded in just days.
But the money to pay them simply wasn't there. It had been funneled away into Alameda's losing bets. Withdrawals froze. The screens stopped updating. FTX was facing a shortfall of around $8 billion.
For one moment, the rival Binance offered to buy FTX and save it.
Then it looked at the books and walked away. On November 11, 2022, FTX filed for bankruptcy.
Sam resigned, and a veteran cleanup executive took over. This was the man who had overseen the wreckage of Enron.
Even he said he had never seen such a complete failure of controls.
The empire was gone. Now came the accounting.
In December 2022, Sam was arrested in the Bahamas.
He was flown to the United States to face trial. His closest colleagues now had a choice to make.
3 of them pleaded guilty and agreed to cooperate.
Among them was Caroline Ellison, who had run Alameda,
and Gary Wang, who had written that secret code.
One by one, they testified against their former boss. In October 2023, Sam Bankman-Fried went on trial in New York. He insisted he had made mistakes, but had never stolen. The jury did not believe him.
On November 2, 2023, he was convicted on all 7 counts. Wire fraud, conspiracy, money laundering. In March 2024, he was sentenced to 25 years in prison. He was also ordered to forfeit $11 billion.
His cooperating colleagues received far lighter sentences. So what happened to all of the customers' money?
Here, the story takes a surprising turn.
As crypto prices recovered, the bankruptcy estate clawed back assets. Most customers are now being repaid in full, with interest. But there's a catch that still stings.
They are repaid based on prices from the day FTX collapsed, back when crypto was near its lowest point, so they missed the enormous rally that came afterward.
Sam Bankman-Fried still maintains he did not steal, and he is appealing. His supporters have even pushed for a presidential pardon.
As of early 2026, no pardon had come.
FTX was sold to the world as the safe, grown-up face of crypto.
Instead, it became one of the largest financial frauds in history. And the lesson is older than crypto itself. When someone holds your money behind a door only they control, you are trusting the door.
On the fraud terrain, we follow the money, and we expose the fraud. If this story gripped you, subscribe, and tell us which case we should uncover next.